Welcome everyone to Nearsight and Farsight. I'm your host, Kevin Taylor, here to talk to you about what's going on in the markets. Every quarter, we take a step back and look at the big picture, where the markets have been, where they stand today, and where they are headed next. And in this update, I plan to walk you through what happened in the last 90 days, how the shifting reads on both GDP, gross domestic product, and inflation have changed the underlying markets and what we expect for the next 6 months to come through the end of the year, and what moves we're making in the portfolio to keep you ahead. So thanks again for joining us. Let's dive in. The first element here is I want to talk about markets and some of the headlines that came out of the earnings over the last 2-3 weeks. Let's start with the overall market backdrop. Over the past 3 months, it's been a real tug of war between surprisingly strong earnings results and the valuations, which we think continue to be stretched. So here's where we stand. In Q2, earnings growth for the S&P 500 came in at 10.3%, which is the third straight quarter of double-digit growth. That is a record. 82% of the companies that released results of the S&P 500, I should say 82% of the companies that released results so far had EPS, earnings per share results that beat revenue forecasts. And while that seems like a great number, here's an important context to be added to that. Much of Q2 was spent talking down those numbers, where companies were pulling forecasts, lowering expectations, and in a lot of cases, just blaming the tariffs for the reason that they have uncertainty. So a lot of these beats are coming in against a grading curve that's been lowered. The bar was lowered through most of the quarter, makes for a really good headline at the end, and those earnings were better than expected, but I think that there is an underlying uncertainty on behalf of the S&P 500 for how much earnings can continue to go up. So valuations, in our opinion, continue to be very, very stretched for the market as a whole. The forward price to earnings ratio is at 22.2, which is well above the 5 and 10 year averages. And while we've seen a persistently high PE ratio, that is high even amongst the high. Backwards looking PE, the current read on the PE is about 30. Both of these just tell me that every dollar that's going into the market right now has more downside than up, and that we should be a little bit more discerning as to where we invest. So this is pushing markets to be pretty range bound into where they're trading, but it's also sending signals that while it's rewarding positive earnings results, we saw that with a lot of household names, it's also sharply punishing negative results. So even though there were a smaller portion of them, 5.6% decline on average for any earnings miss, I just feel like that means that the market has capped how much higher companies can move to the upside on earnings, and has proven that any disappointment is going to be more negatively impacted than it is positively rewarded. So that's kind of how markets have been behaving. I think we also have to talk about how GDP forecasts have also been shifting. Economic growth, the biggest, broadest index of how to measure that is GDP, and so we'll take a look at that. At the start of 2025, GDP growth was expected to come in pretty strong. Consensus expectations back in January are about 3.2% growth for the United States for the year. Fast forward to the middle point, we have had to cut back what GDP expectations look like, roughly expecting that the United States is only going to grow by about 2%, was the July and August reads. So that says as we get closer to the end point, more data is available. They've had to lower that by a full percentage point. And that's a pretty large revision downward on what economists expect the United States GDP to look like. So the first quarter on GDP came in as losses. It was 0.3% negative, which was and a 0.5% was the annualized number. So a negative 0.3 print and a 0.5% for growth. So we had a rough first quarter of the year. A little bit of trickeration in the numbers, because the second quarter GDP showed rebound of 3% growth, but much of that came from very temporary factors, including falling imports. When GDP is a function of both what you produce and what you bring in, and in this case, pulling forward a lot of those imports in the first quarter lowered that GDP print, and now we've stopped importing as a result of tariffs, which catapulted that 3% growth. So it's trickeration on both sides, it's manipulation on both sides. The Q1 numbers aren't as reliable, the Q2 numbers aren't as reliable, but somewhere in the middle of those two different stories is where we're going to end up. The Federal Reserve now sees only 1.4% growth. They were at 1.7 at the very first part of the year, and so they're pretty pessimistic as to what the rest of the year is going to look like and how much we can expect the whole pie to grow. That being said, we've kind of looked at the markets, we've looked at GDP and the entirety of the pie. Let's talk a little bit about the resurgence of inflation in the numbers. Slowing growth is one side of the coin. Inflation is got to be the other, and it's really not where the Federal Reserve wants it, and that is a term that we might hear more of, which is stagflation, where growth and inflation are both symptoms of the broader economy. So right now, the CPI, Consumer Price Index, is at 2.7%. This is a measurement of what the end user, what the consumer is paying for a basket of goods. Then we also look at the Core Consumer Price Index, or sticky CPI, which isolates food and energy. That's actually higher. So energy is actually a disinflationary metric, and the price of everything else is going up, which is pretty indicative, what you would expect if you are tariffing imports and you produce energy domestically. You're seeing the price of energy being low as a boon to the economy, but everything else being a net result of almost a 3% increase from a year ago. Core Personal Consumer Expenditures is at 2.8%. We use that as kind of a confirmation of what we're seeing in the CPI. On top of that, so tariffs and other economists are expecting tariffs, and the Federal Reserve is expecting that tariffs could add as much as 1% to the inflation figure, which is not yet priced in through the end of the year. So that could take a 3% inflation and make it 4%, which would be really problematic, and is why the Fed is kind of holding their cards pretty close to the chest. They do think that they are going to cut rates, but because of that inflation uncertainty in the last 3 months, that inflation number continues to tick back up. They're seeing inflation as being a problem. So what are we going to do? I think that the best way to define our strategy is cautious but ready. As investors, I think it's important to remember that not every market decision is about some big bold move, that we're not going to run from one side of the boat to the other, or that we're going to move our chips around the table with relative certainty. But I think sometimes the smartest play is often just being quiet strength in our positions. And what does that mean for us right now? So what we've been doing, instead of making big, broad, outright changes because the market has been going up, you saw us make some of our bigger, bolder decisions in January and February when we raised money and went to cash. Again, when we went back into the market in April and we saw that turnaround saying, hey, things were back to price. Now we're back at the top end of this market again. So I think, how do we approach a market that we think is really expensive but is also going up? I think it's just start freeing up some dry powder. And so what you've been seeing us do in your portfolios, it's say dividends and interest payments that we collect from our investments, and instead of reinvesting those, we're letting those go to dry powder, which means that we're going to hold some cash reserves to provide us some flexibility down the road should markets pull back. So this is a pretty cautious stance, but it's not a negative one. We are trying to insulate portfolios from near-term risk while trying to stay ahead of some opportunistic entry points that the market might provide for us in the next 3 to 6 months. But we do think that Q4, Q1, when things settle down, markets could find a bottom. So some of the worst months are in the late stages of the summer, September, October, historically being the worst times, but we do see, seasonality pick up and swing through. So we're trying to be cautious, but we're trying to be engaged at the same time. I think the easiest way to do that is just to naturally let dividends build up in the account, which means you'll see us buying SNOXX, which is a cash position, or SWVXX, which is also a cash position, or being in cash outright. Some of the portfolio adjustments that we are making, like I said, moving a few chips around the table, but keeping our strings tight, keeping our sails with the markets as they continue to go up. Some of the positions that we've changed, we've increased our exposure to RSP, which is the broad S&P 500. So shifting from some of the high end into a broader, less volatile space. We've also added XLE, some energy exposure. I think that while energy markets have sold off, they have not looked great this year, they can't stay down there, and we will see a rising cost of oil and energy prices. We have maintained a new exposure to BITW, which is us getting into digital assets, largely as a result of inflation being the cause of government spending and these tariffs. We're looking for a space that is going to thrive in both conditions. And if we don't get a lot of growth in the markets, we could get growth in digital assets. That means the BITW is mostly consistent of the top 10 digital assets, the largest being Bitcoin, then Ethereum, and then the kind of the remainders, XRP, Solana, Avalanche, and a handful of others that we see as having some utility, but as a group, being a way that we can insulate ourselves from inflation and be outside of the market with some growth. And we also own NLR. You've seen us add that. We think the rising cost of energy is probably not going to go away. Demand at data centers, demand for the AI infrastructure, all of this is going to be an asymmetric increase in the cost of electricity. So we think both utilities, you've seen us add that in the ticker XLU, and then NLR, because inside of utilities, we do think that there's going to be a 10-20 year growth in exposure and usage of uranium-based, of nuclear-based power production, power centers. We've removed IHE as a healthcare exposure. We are not leaving healthcare. I think that's actually one of the better priced parts of the market right now. It's had a pretty rough go of it this year. It's been the worst performing sector, but I don't think that's going to stay that way. And it's not for any one cause. You can see that insurance providers have had a couple rough goes of it from mispricing things. The pharmaceuticals have had a rough go of it because they've had some disappointment in earnings and their pipeline development for pharmaceuticals, as well as some headwinds that have come from the new regime. But I don't think any of these are connected to each other. That is typically a space where you see a lot of slow, persistent growth, as well as there is a aging dynamic in America. We have to take care of a class of aging people, and so I don't think healthcare expenditure is going to go down. I think that the price has gone down in that group, but I think the earnings have looked pretty good and remaining pretty strong, and I think that that's one of the better places to own. So we do own more exposure in that space through VHT. And then we are keeping JEPI, JEPQ, DGRO, and COWZ. Those are really consistent cash flow producers for us. A couple of them pay monthly and are part of a derivative strategy that we have to generate income. So all of those are dividends that you'll continue to see get paid, but we want to sit them in cash while we are kind of trying to test these markets out and see how much further they can even rise. So looking ahead, the next chapter of our market story is going to be written by how companies and consumers and policymakers ultimately respond to a lot of those forces that I mentioned before that are now kind of rolling out in slow motion. A new tariff regime, a new inflation regime, and a contraction in growth. So our focus is going to be on spotting opportunities that emerge as the result of that uncertainty and positioning ourselves to take advantage of them. One of which is earnings momentum. I think we're going to see a slowing in that, but you are going to see a lot of different stalwarts come out and get excess reward as a result of kind of bucking that trend. We're looking for that, so we're going to continue to watch earnings to see if earnings can rise to the point where that P to E ratio comes down and we feel a little more comfortable. But we're also looking for those that are bucking the trend of declining earnings in the next 6 months. Tariff uncertainty, we want to look for tariff certainty in all three levels. One, we're starting to get some of this in country of origin tariffs. So as you see the president negotiate at least some indication of these deals, and then we do have one deal that's been inked with the UK. getting more clarity as to which countries are going to be tariffed and at what level. It seems like a lot of that was erratic through the first half of the year, but we're getting a little bit more clarity from some of the more important trading partners, Japan, South Korea, a couple Southeast Asian nations that I feel we have some more certainty on. China's still the big gorilla in the room with that one. There's so much that comes from China, and there's just rampant uncertainty. The second level, which I think we even saw a couple of glimpses into what that's going to look like, is the company level exclusions. So the firms, how they plan to either pass through the tariffs that they're absorbing or that they're brokering deals. You saw that with the Apple deal earlier this week. So the company level clarity is coming into place, and then with that comes product level clarity. And we're seeing that with carve-outs for chip makers. 100% tariff on all chip makers, unless they're doing a project here in the United States, is the type of clarity that we're going to get on what products are going to be tariffed. So looking at those in all three levels is going to determine where the United States regime is picking winners. And we still think that's going to be in U.S. large caps. That is definitely who has the most pricing power, the most control over their supply chain, the largest margins to absorb where they can absorb or pass along. And so, again, that's going to be a lot of tech names. It's going to be a lot of the big names that you hear of on the nightly news. It's going to cause smaller companies to suffer, though. We are starting to see some international shifts, so that's the other place that we're looking to possibly make some changes as a result of all this. Some countries are actually going to benefit from the tariff environment over time as they find new partnerships, and they see that the consumer in the United States is paying 10, 15, 20% more as a result of imported goods, that they can seek markets elsewhere that become more competitive because of how cost prohibitive it is to do business in the United States. That's going to strengthen a lot of international bonds, and it no longer makes the United States the only place to invest. So we are starting to look for some regionality and probably to diversify a little bit away from the United States, but some of that infrastructure, that trade relationship could be decades away. So we're very early innings on that. So as you can see, our bias right now is to dry up some powder where we can, to make small adjustments in the portfolio that you can hopefully understand and get behind and make sense here. That's been our take. We don't think anything is set in stone right now, but we are trying to increase the maneuverability for all of our portfolios should things start to clear up. Or as we kind of anticipate these headwinds starting to play out in the summer months and into the fall, we want to be in a position to be ready. So that's what you're going to see in ours. So this has been Near Sight and Far Sight. I'm your host, Kevin Taylor. As always, reach out to Peter, Carly, or myself if you want to discuss your portfolio in greater detail, and we can talk about some changes that we're making, some insights that we have, and some exciting things that we think are on the investment horizon. Thanks again.